In our previous sessions, we first understood what derivatives are. We said a derivative is a financial contract whose value comes from an underlying asset. Then we discussed the main types of derivatives such as forwards, futures, and options. Forwards and futures create obligation. Options give a right, not an obligation. Then we clearly differentiated between calls and puts. A call option gives the buyer the right to buy. A put option gives the buyer the right to sell. Now that we understand the structure of options, today we will go deeper into four very important terms: strike price, premium, expiry, and lot size. These are foundational concepts. Without clearly understanding these, profit and loss calculations will not make sense. Let us start with strike price. The strike price is the fixed price at which the option contract allows you to buy or sell the underlying asset. Think of it as the agreement price written in the contract. For example, TCS is trading at 2,692 rupees and 20 paise. You can see strike prices like 2,600, 2,680, 2,700, 2,740, and so on. Suppose you buy a call option with a strike price of 2,700. This means you have the right to buy TCS at 2,700 rupees, no matter what the market price becomes before expiry. Now let us see this with numbers from the screen. Current price is 2,692 rupees and 20 paise. If at expiry TCS moves to 2,800 rupees, your 2,700 call allows you to buy at 2,700 rupees. That means you gain 100 rupee per share, 2,800 minus 2,700. This difference between market price and strike price is very important. It represents intrinsic value. If instead you bought a 2,700 put option, you have the right to sell at 2,700 rupees. If TCS falls to 2,600 rupees at expiry, you can sell at 2,700 rupee, while the market is 2,600 rupees. That gives you 100 rupee per share advantage. So strike price defines the fixed contractual level at which your right operates. At this stage, a beginner may get confused and think, if I buy a 2,700 put, how can I sell at 2,700 rupee if I don't own any TCS shares? The answer is simple. When you buy a put option, you are buying a right, not actually selling shares immediately. You are not required to own the shares beforehand. For example, the 2,700 put premium is 74 rupees and 40 paise. If you buy it with a lot size of 175, your total investment comes to 13,020 rupees. Now suppose at expiry TCS falls to 2,600 rupees. Since your strike price is 2,700, you have a price advantage of 100 rupee per share. With 175 shares in one lot, that price advantage translates into a total value of 17,500 rupees. You do not need to bring 175 shares and sell them physically. The exchange simply calculates the difference and settles it in cash. So after recovering your initial investment of 13,020 rupees from the total value of 17,500 rupees, your net profit comes to 4,480 rupees. So remember this clearly. Buying a put does not require owning shares. You are trading the contract, and profits are settled based on price difference. Now let us move to premium. Premium is the price you pay to buy the option contract. It is not the price of the stock. It is the price of the option itself. In the screen, premium is shown as LTP. For example, at strike 2,700, the call option premium is 67 rupees and 25 paise. The put option premium at the same strike is 74 rupees and 40 paise. If you want to buy the 2,700 call, you must pay 67 rupees and 25 paise per share. Now let us calculate the total investment using lot size 175. The premium of the 2700 call is 67 rupees and 25 paise. When you multiply this by the lot size of 175, the total premium paid comes to 11,768 rupees and 75 paise. This 11,768 rupees and 75 paise is your maximum possible loss as a buyer of that call option. Now suppose at expiry TCS closes at 2,800 rupees. Your strike price is 2,700 rupees. So you have a price advantage of 100 rupee per share. With 175 shares in one lot, that price advantage translates into a total value of 17,500 rupees. If you deduct your initial investment of 11,768 rupees and 75 paise from this total value of 17,500 rupees, your net profit works out to 5,731 rupees and 25 paise. So remember this clearly. Premium is your cost. Strike price defines your contract level. The difference between market price and strike price creates intrinsic value. After deducting premium, what remains is your actual profit. Now let us take another example. Look at the 2600 call. The premium is 127 rupees and 45 paise, and the current price of TCS is 2,692 rupees and 20 paise. Since the market price is above the strike price, this option already has intrinsic value. The difference between 2,692 rupees and 20 paise and 2,600 rupee gives you 92 rupees and 20 paise per share as intrinsic value. But the option is trading at 127 rupees and 45 paise. The extra amount over 92 rupees and 20 paise represents time value. Now let us calculate the total premium paid. When 127 rupees and 45 paise is multiplied by 175, the total investment comes to 22,303 rupees and 75 paise. For this 2,600 call, your break-even at expiry would be the strike price plus the premium paid. So when 127 rupees and 45 paise is added to 2,600 rupees, the break-even price becomes 2,727 rupees and 45 paise. So even though the option already has intrinsic value, you need price to go above 2,727 rupees and 45 paise at expiry to make net profit. Now let us understand expiry. All these contracts are valid only till the selected expiry date, which is 24th February 2026 inches this case. After that date, the option contract ceases to exist. Suppose you buy the 2,740 call at premium 49 rupees and 85 paise. Total investment is 49.85 times 175. That is 8,723 rupees and 75 paise. If on expiry TCS closes below 2740, the option expires worthless. Your entire 8,723 rupees and 75 paise becomes zero. That is why options are called wasting assets. Time keeps reducing. If price does not move in your favor before expiry, premium erodes. Expiry creates time limitation. Unlike stocks, options cannot be held for long period. Now let us clearly understand lot size. Lot size defines how many shares one option contract represents. In this case, lot size is 175. All premium and profit calculations must be multiplied by 175. For example, at strike 2680, the call premium is 77 rupees and 25 paise. With a lot size of 175, your total investment comes to 13,518 rupees and 75 paise. That is the total amount you're putting at risk as a buyer. Now suppose at expiry TCS moves up to 2,800 rupees. Since your strike price is 2,680 rupees, you have a price advantage of 120 rupee per share. When this 120 rupees is considered across 175 shares, the total value of the option becomes 21,000 rupees. After recovering your initial investment of 13,518 rupees and 75 paise from this total value of 21,000 rupees, your net profit works out to 7,481 rupees and 25 paise. Without multiplying by lot size, your understanding of capital requirement and risk would be completely wrong. Now let us connect all four terms in one structured example. The current price of TCS is 2,692 rupees and 20 paise. You choose the 2,700 call option. The premium is 67 rupees and 25 paise. Lot size is 175. Expiry is 24th February 2026. Since the premium is 67 rupees and 25 paise per share, when multiplied by 175, your total investment comes to 11,768 rupees and 75 paise. This is the maximum amount you can lose as a buyer. Your break-even will be the strike price plus the premium paid. So when 67 rupees and 25 paise is added to 2,700 rupees, the break-even level becomes 2,767 rupees and 25 paise. Only above this level at expiry will you start making net profit. Now let us see both outcomes clearly. If TCS closes at 2,600 rupees on expiry, the option has no intrinsic value because the market price is below the strike price of 2,700 rupees. In that case, the premium you paid will become zero and your total loss will be 11,768 rupees and 75 paise. If TCS closes at 2,800 rupees on expiry, the option will have intrinsic value. The price advantage is 100 rupee per share. Across 175 shares, that gives a total value of 17,500 rupees. After deducting your initial investment of 11,768 rupees and 75 paise from 17,500 rupees, your net profit comes to 5,731 rupees and 25 paise. I think by now, you can clearly see how strike price, premium, expiry, and lot size are interconnected. They're not separate concepts. They work together to determine risk, reward, and break-even. I have deliberately repeated the calculations at every stage. Once these calculations become automatic in your mind, topics like moneyness, time value, and even option Greeks will become much easier. In the next session, we will move into the concept of moneyness, which simply means understanding whether an option is in the money, at the money, or out of the money. This is where everything we discussed in this video starts fitting together in a very structured way. Once you understand how strike price compares with the current market price, you will immediately be able to classify options logically instead of guessing. That is the point where reading option chain stops looking complicated and starts looking systematic. And once that clarity comes, strategy selection also becomes much more structured.